His name was David, and this is $5. Most people would spend it without a second thought. A coffee, a snack, a download, gone before lunch. In fact, the average person spends roughly $5 a day on things they cannot remember by the end of the week. But David made a different choice. 30 years ago, David started investing just $5 every single day, not 50, not 500, 5. The price of a coffee. He never missed a day. He never increased the amount. He never picked individual stocks or tried to time the market. Just $5 every day for 30 years. And today, we are going to show you exactly what happened. The real number, the real math, and the one principle behind it that most people never learn until it is far too late. But before we get into the numbers, if you are new here, welcome to Finext Wealth. Every week on this channel, we run the real math on the financial decisions most people make on instinct. No hype, no get-rich-quick schemes, just clear, honest numbers that change how you think about money. Hit subscribe and join us because the next few minutes might genuinely change how you see every dollar you spend. Now, back to David. Let us start at the very beginning. The year is 1994. David is 32 years old. He is not rich. He is not a financial genius. He works a regular job, earns a regular salary, and lives a regular life. But David has one habit that most people his age do not. He reads about money. And one evening, sitting in his local library, he reads something that stops him cold. A simple table, nothing fancy, just numbers. It shows what happens when you invest a small, fixed amount every single day over a long period of time and let compound interest do its work. David does the maths on the back of a receipt. $5 a day is $150 a month. $150 a month, invested consistently at an average market return of 8% per year, over 30 years. David circles the number, stare at it, then read it again. $204,000 plus, $204,000 from $5 a day, starting tomorrow. David closes the book, walks home, and opens an investment account that same night. Now here is where the story gets honest. Because the first year, it felt like absolutely nothing. David invested $5 a day, every day, no exceptions. By the end of month 1, his account held $150. After 6 months, $900. By December, $1,800. And the interest earned in that first year, $144. Not exactly the stuff of legend. In fact, if David had told his friends what he was doing, most of them would have laughed. Why bother investing $150 a month? Just enjoy your money. You are only young once, and that is exactly the point. Compound interest does not perform for an audience. It does not reward people who check their balance every day looking for drama. It rewards one thing and one thing only: patience. David understood this. He had read the chart. He had seen where the line goes, so he kept going. Let us move through the first decade quickly, because honestly, the first 10 years are where most people give up. Year 1, $1,800 invested. Account value, $1,944. Year 3, $5,400 invested. Account value, $6,200. Year 5, $9,000 invested. Account value, $11,000. Now pause here for a moment, because this is exactly where most people look at their investment account and feel underwhelmed. They think, I have been doing this for 5 years and I only have $11,000. That is nothing. And they stop. But David does not stop. Because David has seen the chart. He knows what is coming. He knows that compound interest is not a sprint. It is not even a marathon. It is an avalanche building at the top of a mountain. Silent, invisible, and then unstoppable. By year 10, David has invested $18,000 of his own money. His account balance, $28,400. $10,000 of that is pure interest. Money David never earned, money his money earned. He is starting to see the avalanche move. Year 15, David is 47. His hair is a little grayer. His shoes are a little more worn. He still makes his own coffee every morning, and he still invests $5 a day, same amount, no changes, no drama. His total personal contributions over 15 years, $27,000. His account balance, $53,800. The gap is now $26,000. That is $26,000 David never worked for, never saved, never earned from his job. His money has now earned more than half of what he personally contributed. Think of it this way. By year 15, David has a silent business partner. He never had to hire this partner. He never had to manage them. He never had to pay them. They just showed up one day, small, unimpressive, and quietly got to work. And now, they are earning $26,000 on David's behalf. While he sleeps, while he watches television, while he takes a Sunday afternoon walk, year 20, David is 52. He has now invested $36,000 of his own money over 2 decades. His account balance, $91,400. $55,000 of that balance is pure return. More than 60% of David's wealth now exists because of compound interest alone. His $5 a day habit has created a second financial life, one that grows whether he shows up or not. And here is where the magic of this story begins to feel almost unfair. Because the best years, they have not even started yet. Year 25, David is 57, same house, same kitchen, same coffee. He has invested $45,000 of his own money over a quarter of a century. His account balance, $146,000. $101,000 of that is pure compound return, more than twice what David ever personally put in. But this is not even the number that matters most. Because David kept going, $5 every day, no exceptions, rain, recessions, market crashes, global pandemics, political chaos, $5, year 30. David is 62 years old. He opens his investment app, the same one he has used for 3 decades, now on a smartphone instead of a desktop. He looks at the balance, $204,382 from $5 a day from the price of a coffee, from a number so small that most of his friends never believed it was worth doing. Now let us break down exactly where that money came from. Over 30 years, David invested a total of $54,750 of his own money. That is it. $54,750 spread over 30 years, $5 at a time. His account grew to $204,382, which means $149,632 was money David never earned, never worked for, never saved from his salary. It is money that existed purely because of time and consistency. Look at that ratio. Less than 27% of David's final wealth came from what he actually put in. More than 73% came from compound interest, 73 cents of every dollar in that account. David's money earned, not David. And here is the number that will stay with you long after this video ends. In the final 5 years alone, years 25 through 30, David's account grew by $58,000, more than he contributed in his entire first 20 years combined. This is why compound interest is so brutal to start late. The growth is not linear. It does not spread evenly across 30 years. It accelerates. It front-loads the patience. It backloads the reward. The people who start late are not just missing a few years of growth. They are missing the years when the avalanche finally hits the valley. Remember David's friends? The ones who spent their $5 a day without a second thought? Let us check in on them. Marcus spent his $5 daily on coffee, lunches, and impulse purchases for 30 years. By 62, Marcus had zero in investment savings. He is still working. He plans to retire at 70 maybe. James started investing at 42, 10 years after David. Same amount, same rate of return. He invested for 20 years instead of 30. James's balance at 62, $87,000. 1 decade of delay cost James $117,000. Not because James was less disciplined than David, not because James was less smart or less hardworking, simply because James was 10 years late. And Sandra decided at 32, the same age as David, that she would invest more but start later. She would wait until she earned more money. She would invest properly with a larger amount when the time was right. The time never felt quite right. Sandra started at 52. She invested $15 a day, 3 times David's amount, for 10 years. Sandra's balance at 62, $81,000, 3 times the daily investment, a third of the time, less than half the result. Because the most valuable ingredient in compound interest is not the amount, it is time. Time is the one resource you cannot buy more of. You cannot hustle your way into more time. You cannot earn a bonus that gives you back the years you did not invest. You either start or you do not.
So what does David's 30-year story actually teach us? 3 things. Just 3. Lesson 1. Start before you feel ready. David did not wait until he had more money. He did not wait for the perfect market conditions. He did not wait until he fully understood investing. He started with $5, the smallest possible commitment, because starting imperfectly is infinitely more valuable than planning perfectly. The best time to start was 30 years ago. The second best time is today. Lesson 2, the amount matters. Less than the consistency. $5 a day, every day. Not $500 when he remembered, not a big annual contribution when he had spare cash. Every single day. Consistency is the engine. The amount is just the fuel. A small engine running every day will always outperform a large engine that only starts occasionally. Lesson 3. Ignore the noise. Trust the math. In 30 years, David watched markets crash and recover. He watched recessions come and go. He watched financial experts predict catastrophe and be wrong. He kept investing because David did not invest based on how the market felt that week. He invested based on how mathematics works over decades. And mathematics does not have bad days. David never earned a fortune. He never got a windfall inheritance. He never picked a stock that went to the moon. He never built a startup or sold a business. He invested $5 a day for 30 years. And today, say at 62, David does not have to work if he does not want to. Not because he is lucky, not because he is special, but because 30 years ago, he picked up a $5 bill, looked at it for a moment, and made a different choice. We return to the opening shot. David's hand holding the $5 bill over the kitchen counter. The same shot from the hook, but now we see it differently. The bill is not just $5, it is 30 years of patience. It is $200,000. It is financial freedom. That $5 bill is still in your pocket. The question is, what you do with it today. Every week on this channel, we take one financial decision that most people make on instinct, and we run the real numbers, so that the next time you stand at a fork in the road, you already know where both paths lead. If this video made you think differently about the small amounts, share it with someone who needs to see the math before it is too late. And subscribe, because next week, we are running the numbers on the new car versus used car decision, and the 30-year gap will genuinely shock you. We will see you then.